With me, I have Professor Robert Shiller, 2013 winner of the Nobel Prize in Economics and one of the foremost stock market economists of our time. Professor Shiller, now you're talking about the new normal boom at the moment, 2009 to 2015. Talk us through the characteristics.
Well, I'm referring to a general fear that I think pervades much of the world. It's a fear of secular stagnation, it's a fear of inequality, and a fear of new technology that might generate inequality. And it's a fear that individuals have about their own future.
Now, you're sometimes nicknamed the Cape Crusader for your cyclically adjusted price-earnings ratio. I'll leave you to explain that, but this is a measure of sort of the market valuation at the moment. It's screaming overvalued on US stocks. Yeah. Just talk us through why that is.
The price-earnings ratio has been used for over 100 years to value companies, but there's a problem with the conventional price-earnings ratio, which has price divided by just 1 year's earnings, because from 1 year to the next, earnings are highly volatile. I worked with John Campbell at Harvard University on this years ago, in the late 1980s, and we found that it's better to smooth the CAPE ratio, the earnings in the denominator. We smoothed it over 10 years. And then the price-earnings ratio actually works to forecast future price changes.
Now, you're saying effectively then that stocks are overvalued. Most of the world thinks bonds are overvalued at the moment. There's a bubble forming there. What is an investor to do? How do we interpret this?
There's something very real and important for an individual investor to do, which is save more and diversify. Some people are going to be really disappointed when they retire in 20 years to see what their portfolio looks like. It hasn't grown at all, and that's a problem.
You've also applied CAPE to some other markets which don't, thankfully, look quite so overvalued. We're here in Hong Kong. What are some of the Asian markets you've looked at?
Well, Japan looks high, but China looked much better just 6 months ago. You know, I was telling people China looks great. Not quite so great anymore. The CAPE has shot up. But still, Hong Kong and Singapore are moderate.
Now, by your measure, using CAPE, US stocks have been overvalued for something, mostly for the last 2 decades. You know, there are critics of CAPE who say perhaps you're not taking enough account of changes in the composition of earnings, the way accounting standards are applied, etc. What's your defense to this?
Well, I don't necessarily say that CAPE is 100% correct. I will say, though, that it did do something fairly well. Back in 2009, CAPE got down to 13, which was below average historically, so it hasn't always been high. And you know what? As I said 2009. That was a good time to go into the market. So I don't think CAPE was useless over this whole period, not at all.
You talk about the new normal boom now, and you've characterized different periods in the market differently. What's the difference between the previous boom and the one now?
Well, the really big boom was from the early 1980s until 2000. I call that the millennium boom. I think that was a time of great positive feelings about the future. It was like a gold rush. It's not the mood that we have now. It's much more circumspect and worried now. But it's still a boom, because when people worry, they can bid up prices of savings vehicles. It's different. It's a different motivation.
Professor Shiller, thank you very much.
My pleasure.